Assalamualaikum. We are from Group 1. We present for the Chapter 22, Audit of Capital Acquisition and Repayment Cycle. This is my group member, Nur Auni Shazana, Alia Dayana, Izam Fatini, Nur Amalina, Fauna Balkis Kristina, and Farisha Adrina. Okay, for the introduction, I will explain about for capital acquisition and repayment cycle. Capital acquisition means that it's a capital account. For example, when we do a business expansion, so we need more capital. The capital resource through issuance of loan and shares capitals. Next, for the repayment cycle is referring to the repayment of interest on loan and payment of dividend to the shareholder. Repayment of interest on loan need to be paid by monthly basis, and for the payment of dividend pay by annually depending on the performance of the company. Next, I will explain about 4 characteristics of the capital acquisition and repayment cycle. First, relatively few transactions affect the account balance, but its transaction is often highly material. Means that the capital acquisition have a few transactions in the company, but each transaction have a large amount. For instance, we wish to expand our business. We will require additional capital from a bank. This loan will not be applied every year, as we will use it only when we having a financial difficulties or we want to add additional capital. In audit engagement, it is not necessary that we will find a new loan when we audit. So, if there is no loans, mean that is no additional long-term liability to the company. But you will audit the existing loan. Next, for the exclusion or misstatement of the single transaction can be material. If there is unrecorded loan or liability, so the effect statement of single material can be material in the financial statement. This is because now recorded one single liability. When you exclude a new loan from a soft bit of our finance statement of effect, so it highly material. Thirdly, it a legal relationship as is between the client entity and the holder of the share bond or similar ownership document. When a company issue a share, automatically they have play a legal relationship between the shareholder and the client. Lastly, a direct relationship exists between the interest of dividend account and debt equity. When the audit of interest-bearing account, auditor should verify the related interest, expenses, and interest payable. This is applied to honor equity, dividend declared, and dividend payable.
Hi, Assalamualaikum. My name is Nur Amalina binti Ahmad. So I will continue with the account in the cycle. So we divided by 3, which is the first one is debt financing account, second equity financing account, and the last one is capital account. So the first one, debt financing account, we have 6 cycle. The first one is notes payable. The amount of principal due on a formal return promise to pay. Loans from bank are included in this account. This represents short-term borrowings that typically due within a year. Auditor will verify the existence and validity of these notes, ensuring they are properly authorized and recorded at the correct amount. Second, contracts payable. If you have a large project going on, do not rely on the payable report alone and make a list of all contractors on the project, which is these liabilities arise when a company receives goods or services but has not yet paid by the supplier. Auditor will confirm the validity of this contract, ensuring they are recorded at the appropriate amount and reflect the actual goods or services received. The third one, mortgage payable, a liability account whose balance in the unpaid principal balance as of the balance sheet date. The amount of principal required to be paid within 12 months of the balance sheet date is reported as a current. Next is bond payable, form of long-term debt. Bonds are issued by corporation, hospital and government. For example, public utilities will issue bonds to help finance a new electronic power plants. Hospitals issue bonds for a new building, and government issue bonds to finance project, cover deficit or to pay for older debt that is now maturing. Next, interest expenses is non-operating expenses shown on the income statement that it represents the interest payable or any type of borrowing such as bonds, loans and convertible debt or lines of credit. It is basically calculated as the interest rate times the outstanding principal amount of the debt. The last one for the debt financing account, accrued interest, the amount of interest that has accumulated on a debt since the last interest payment date. This account reflects interest expenses that has accumulated but has not been paid yet. Auditor will ensure the interest is calculated correctly based on the outstanding debt balance and the applicable interest rates. So the auditor of this account for the debt accounting, financing accounting, ensure the company has accurately recorded its debt and the related interest expenses. Auditor will verify the existence and validity of this obligation along with the proper calculation and recording of the interest. We move to the equity financing account. So the first one is appropriation of retaining earning. Is a contra equity account. The appropriated retained earning are any unappropriated retained earning that are specifically not to be used for dividend payment. That retained earning that have been set aside by action of the board of directors for a specific use. This means it reduces the balance of retained earning without technically being an expenses or any distribution to the shareholders. That company create appropriation to restrict the use of a specific portion of their retained earning for a designated purpose. Next, treasury stock, the portion of share that a company keep in their own treasury. Treasury share may have come from a repurchase or buyback from the shareholder, or it may have never been issued to the public in the first place. These are shares a company buys from the investor. Auditor will verify the number of share repurchased, the cost of acquisition and the proper tracking of the share on the balance sheet. Next is dividend declare, when a company has issued a dividend payment but the payment has not been sent to investor. Next is ordinary share, is an equity instrument subordinate to all other equity classes that the holder of an ordinary share participate in an equity profit only after all the other type of share have participated. Ordinary share rank lowest in the capital structure hierarchy. This means that they have the weakest claim on the company asset and profit compared to the other equity classes. During the audit, auditor consider the existence of other equity classes with the prior claim.
Assalamualaikum warahmatullahi wabarakatuh.
Next, cash in bank. The sum of all coins, currency and cash items have been placed on deposit with the financial institution. So this represents the company's most liquid asset. Auditor will verify the company cash balance through the bank reconciliation, ensuring the recorded cash match actual with the bank statement.
Assalamualaikum warahmatullahi wabarakatuh. My name is
Preference share consists of company share
Thank you to Alia for
that
the
are
share
paid
for
to
HCA
shareholder
and
before
considering
ordinary share
control
dividends are paid out.
transaction and also untaken
Donated capital
Okay.
is a gift of
So for
asset
test of
to a
control,
company
it
usually
involves
by
the issue
state
of
or
notes
local
and
government
repayment
to
of
include
principal
the
and also
business to
interest. Okay.
relocate to their
Test of
justification.
control, actually we want to
Part
test
of
our
shareholder
client
equity
either they are
representing
record
the fair
amount
market
for
value
loan,
of an
loan
asset
payable
at the time
accurately
it
or
was
not.
received
So
as a gift.
how
These are
to
contribution of asset
how
from
to make sure
donor,
that
not involving
the
any
loan
exchange
transaction are
of
being
cash.
entered in the
Auditor will
system
ensure
are accurate.
the-
So what
this
we as an
can
auditor
have
can
a
do
fair
is we
value
can
of donated
send
asset is
confirmation request
properly
to the banks
recorded
or
and
other lenders
classified.
to verify the loan balance,
Next one,
interest rate,
dividend
payment
payable
schedule,
that a
and also
company's
any
board
other
of directors
terms
has
of
declared to
the
be
loan
payable
directly with the
to
lenders.
its
Okay.
shareholder.
For example,
The last one,
we
for
as
the
auditor, we
equity
can send
financing
confirmation
account,
request
retained
to
earning.
Maybank. For example,
This
our client is
account
company X.
represents the
Okay, so
company
company
accumulated
X
profits after dividend
have
have
loan
been paid to
with
shareholder.
Maybank, so we can send the
Auditor will
confirmation
review the
request to
company's
the
earning
Maybank
statement
in order
and
to get
ensure
the
retained earning
complete
are accurately calculated and
for example,
reflected.
loan balance,
So we
so
move
that
to the last
we can know that our
account, which is
client
capital
are
account. We
paying
have
them
two.
accurately with
Proprietorship
the
capital account,
principal
the
rates
type of
given,
business entity that
so
is
they
owned
are
and
paying
run by
accurately or
one
not.
natural person and in
The
which
amount
there
of
is
the
no
loan
legal distinction between
includes
the
the
owner and the
interest
businesses.
rates given
The
by the
simplest
bank.
business from the under which one can operate a business and not a legal entity, and also a person who owns the business and is personally responsible for its debts. The second one, partnership. An equity account in the account records of a partnership and the amount of money or other property that all the partner have contribute with the agreement of the other to permanent endowment of the firm. So the audit of this account focus on ensuring the company has properly recorded and disclosed its ownership structure and how it distribute profit to shareholder. Auditor will verify the number of share issue, the appropriate classification of capital resources, and the accuracy of dividend calculation and payout.
I will continue for methodology for design and test of value liabilities. In this methodology, we have 3 phases. The first thing we have to do in phase 1 is identify client business risk affecting long-term liabilities. Business risk is an exposure of a company to a risk that can cause lower in profit or failure in business. It is important for the company to identify the business risk because it can affect a long-term liability. Let's say the client is unable to get profit or having poor cash flow, it will affect the company to pay installment to the bank. The next step is in the phase 1 is to set tolerable misstatement and assess inherent risk for long-term liability. Usually, the tolerable misstatement in the cycle is lower, and one of particular factor that can increase inherent risk is presence of related party transaction. The most important balance related assertion in long-term liability are completeness and auditor focusing more on this since not payable is a liability and misstatement could be material if even one note is omitted or incorrect. There is more chance for client to understand the liability. The last step is assess control risk for long-term liability. Control risk is the auditor assessment that is likelihood that misstatement is exceeding the tolerable amount and will not be prevented or detected by the client internal control. Long-term liability is highly material and need high-level approval from board of director or management. In phase 2, we have designed and performed test of control and substantive test of transaction for capital acquisition and repayment cycle. In certain instances, additional tests of control may be performed as part of test of detail balance due to the materiality of individual transaction. Test of control for long-term liability and related interest should emphasize testing the 4 important internal control. The result of substantive tests of transaction normally less important because the cycle only contains a few transactions. In the last phase, we have to design the perform analytical procedure for long-term liability and design tests of detail of long-term liabilities balance to satisfy balance related audit objective. Analytical procedures are essential for long-term liability because tests of detail for interest expenses and accrued interest can be frequently be eliminated when results are favorable. Tests of detail of long-term liabilities will be designed in respect with audit procedure in the cycle where is no sample size because we use 100% audit since we only have a few transactions. So, no sampling on loan is made. The more audit procedure we perform, the more item we need to select. And for timing, should be much as possible closer to the ending of the accounting period. So, that we'll able to achieve ending balance at the end of the accounting period.
Assalamualaikum warahmatullahi wabarakatuh. My name is Ala Diana and I will proceed to the next slide, which is notes payable. Basically, notes payable is a legal obligation to a creditor. It is divided into two, which it may be secured or unsecured by asset. Most of notes payable are issued for a period of time between 1 month or 1 year. Notes payable have a written agreement which signed by two parties, the borrower and the lender, and is issued by a financial institution. The written agreement will clearly state the terms and conditions like repayment schedule, principal amount, interest rate, and date of maturity. Next, I will casually explain the differences between account payable and notes payable. The first point is account payable is always a short-term obligation to the business. Meanwhile, notes payable can be both short-term and long-term obligation to the business. Account payable can be converted into notes payable, but notes payable cannot be converted into account payable. The third point is that the amount of account payable is generally due to the vendors and the supplier of the company. Meanwhile, notes payable are the amount which is due to the financial institution and the credit companies. Last but not least, there is no specific term under account payable and no specific payment obligation to the creditor. But for notes payable, there is a specific payment term such as the maturity period, interest rate, clauses for non-payment, and etc. The next slide would be objective of the audit of notes payable. There are three main objectives. The first one is internal control over long-term liabilities are adequate. This is to ensure the accuracy and reliability of the company's financial statement. The second one is transactions are properly authorized and recorded. This objective is to ensure the integrity of company's financial data and avoid misstatement or fraud occur. The last objective is the related liabilities and expenses are properly stated. This is to ensure the financial statements accurately reflect a company's financial obligation for their past transaction. Next, I will go further about the internal control. There are 5 audit procedures for internal control. The first one is proper custody over assets and records. It keeps the asset of the company safe by using physical safeguard. For example, to keep cash, inventory, equipment, and security of the company. Security mentioned before is the investment of the company. Secure storage also can be used for custody of records, for instance, for keeping physical and electronic records. Next, proper authorization for the issue of new long-term liabilities. Board of Directors or high-level management are the ones who are responsible over issuance of new notes. 2 signatures of properly authorized officials are required for all loan agreements. When notes are renewed, they need to be subject to the same authorization procedures as those for the issuance of units. In addition, adequate controls over the repayment of principal and interest should be subjected to the control in acquisition and repayment cycle. At the time the notes were issued, accounting department should receive a copy of the note, same as like how they receive vendors' invoices and receiving report. Account payable department should automatically issue check or electronic fund transfer for the note when they become due. A copy of the notes will provide the supporting documentation of the payment. The second last point is proper documents and record. This includes subsidiary records and control over blank and paid notes by an authorized person. Paid notes should be cancelled and returned under the custody of an authorized official. Lastly is periodic independent verification. Periodically, the detailed notes record should be reconciled with the general ledger and compared with the notes holder records by an employee who is not responsible for maintaining the detailed record. At the same time, an independent person should recompute the interest expense on notes to test the accuracy of the record keeping. As you can see in the slide, here is an example of journal entry of loan payable and the related interest account. You can also turn to page 680 in the textbook figure 22.1 that showed the same journal entries. It contained notes payable, interest expense, cash in bank and interest payable. Interest expense, also known as accrued interest, which is the account already due but the client did not pay yet the expenses. That's all from me. I will pass to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh. My name is Fauna Balkis Kristina binti Yaakob. So thank you to Alia for the explanation for objective, and I will continue with test of control, substantive test of transaction and also analytical procedure. Okay. So for test of control, it involves the issue of notes and repayment of principal and also interest. Okay. Test of control, actually we want to test our client either they are record the amount for loan payable accurately or not. So how to make sure that the loan transaction are being entered in the system are accurate. So what we as an auditor can do is we can send confirmation request to the banks or other lenders to verify the loan balance, interest rate, payment schedule and also any other terms of the loan directly with the lenders. Okay, for example, we as auditor, we can send confirmation request to Maybank. For example, our client is company X. Okay, so company X have loan with Maybank, so we can send the confirmation request to the Maybank in order to get the complete for example loan balance, so that we can know that our client are paying them accurately with the principal rates given, so they are paying accurately or not. The amount of the loan includes the interest rates given. Okay, next analytical procedure for loan payable. So based on analytical procedure here, what auditor need to do is recalculate the interest expenses. Okay, what auditor need to do actually first need to gather all the information and understand the loan term, client's loan term, and also need to recalculate the interest expenses. Actually, logically, it's not that easy, but logically we can calculate based on their early year balance, and also we need to know how much the principal rates, and then we can get how much the loan already paid by client. And normally bank will provide fixed rates unless there's announced by Bank Negara to increase the interest. Okay, next I move to possible misstatement from the analytical procedure that I have stated before. Okay, why we need to recalculate the interest rate? Because there are two situations here. The first one, interest expenses. Okay, so incurred interest rate application is, it happens when our client are using an incorrect interest rate for the calculation. For example, our client have a loan bank with Maybank 100k with 4.5% interest rate, but once we find out that our client only paid for 4% interest rate, so from this recalculation we can find out either our client are paying the bank accurately with the principal rate given or not. Okay, next, the second situation here, failure to accrue interest payable. So meaning here that our client did not record interest that have been incurred but not yet paid by at the end of the period. So what happened? So it may lead to an understatement of expenses and also liabilities, and an overstatement of net income and equality. So they might want to show that their financial statement looks favorable. Okay, next we move to analytical procedure for the notes payable. First analytical procedure here is compare individual loan outstanding. So what auditor can do is, for each loan, we can compare the outstanding balance at the end of the current year with the outstanding balance at the end of the prior year. So we can note that the differences between the two balances for each loan. Okay, next analytical procedure is compare expected changes. How? For each loan, we can calculate the expected reduction in the loan balance based on the installment payments made during the year. So, this can be summarized as we can verify if this expected current year balance match the actual current year for each loan. So, next is compare the total balance in the loan payable, interest expense, accrued interest with prior year balance. So, as I mentioned before, we can use the early year balance minus with the total installment, and also we can get the interest amount. Okay. Okay, next we move to possible misstatement from the analytical procedure that I have stated before. Okay, first, if we do not recalculate or we do not compare the early year balance with the total installment, so our client might doing fraud such as fictitious loans, unauthorized borrowings, or misappropriation of funds. For example, once we calculate the interest rate or the total loans, we might find that our client have any other borrowings from other banks, for example, but they did not record in their financial statement. Okay, next, loans that were obtained or repaid during the year may not have been recorded accurately. For example, as I stated before, our client have any other loan, for example, mortgage loan with Bank Islam, but they did not disclose in their financial statement. Okay, next, the prior year loan balance might have been misstated, leading to incorrect comparison. For example, they might put the wrong amount, wrong prior year loan balance, which is, for example, should be early year balance should be 3 million, but as stated in financial statement, they put the wrong amount. So we need to recalculate in order to get the correct total loan amount paid by the client. Okay, next we move to major balance related to audit objective in loan payable. Okay, the first one is completeness. So situation here is these client loans actually already exist and the transaction are valid. So we need to check whether the client paid and record or not. So that is our main objective. So what if our client did not record? So from the checking, we might know if there are any hidden transaction unrecorded by the client. Okay, the second situation here is about the accuracy. So auditor need to make sure the calculation of the interest is correct based on rate and term given by the bank. As I give the example before, we need to calculate either our client are using the correct principal rate given by the lenders or bank. Okay, so what's the implication? From the calculation, auditor can detect if our client might deceive in calculation interest expenses. So here are loan payment schedule that I stated in slide here. So there are two types loan payment schedule that I put here, which is the first one got security part. So under security part here, meaning when our client pledge their pledge asset or collateral before they want to submit their loan. So they pledge their asset, for example, their building or mortgage, in order to get loan from bank or lenders. So the second payment schedule here, which is same goes to amortization schedule. So this schedule stated when our client paid their loan payment loan, and also how much the interest, principal interest that they should pay. That's all my part. I pass to the next presenter. Thank you.
Assalamualaikum, I'm Izan Fatini and I'll be presenting on honest equity. So it's divided into two, which are public listed company and private limited company. Public listed company has many shareholders and frequent transactions, meanwhile private limited company has few simple transactions that are occasional and few shareholders compared to public listed company that has many shareholders. Private limited only has few. Both of them will have capital and ordinary shares, as well as certain earnings and related dividends. Okay, so next let's dive into internal control. This one is proper authorization of transactions. Majority of equity transactions must be approved by the board of directors, and this includes transactions such as the issuance of capital shares, which are ordinary and preference shares, number of shares, par value, and date of issued. The next one is repurchase of capital shares. Also involve both ordinary and preference shares. And the last transaction is declaration of dividends, which are term of the dividend and cash of shares. The next internal control is proper record keeping. So when a company maintains its own records of shares transactions and outstanding shares, the internal control must be adequate to ensure that the actual owners are recognized in the record and the correct amount of dividends is paid to the shareholders and the potential of misappropriation of assets is minimized. So there are few documents that should be maintained, and there are capital share certificate records, and also shareholders capital share master file. These two documents are so important to keep maintained. Okay, so the last internal control is segregation of duties. So the individual responsible for issuing, transferring, and cancelling share certificates should not have any accounting responsibilities. And also, the individual responsible for maintaining the detailed shareholders records should be independent of the maintenance of the general ledger control accounts, as well as the individual responsible for maintaining the detailed shareholders records should not also process cash receipts or disbursements. And the last one, appropriate segregation of duties should be established among the preparation, recording, signing, and mailing of dividend checks. This is to ensure the presence of segregation of duties is there to ensure proper and good adequate internal control.
Assalamualaikum. My name is Farisha Rina Muhammad Rozaini. Next, I will present about Independent Share Registrar. Company with share listed on Security Exchange is required to engage Independent Share Registrar as a control prevent to the improper issue of share certificate. Other than that, when there is a change in the ownership of the share, the registrar is responsible for signing all new share issue certificate and making sure that all certificate are received and cancelled before replacement certificate is issued. Okay, many companies employ a share transfer agent to maintain the shareholder records, including those documenting transfer of the share ownership. The employment of a transfer agent helps
strengthen control over the share record by putting the record in the hand on an independent organization, and will help to reduce the cost of the record keeping by using specialists. Next is audit and capital share and paid in capital. Okay, first one is completeness. Completeness is existing capital's share transaction were recorded. It happen when a register or transfer agent is used. Then the auditor can confirm with them whether any capital share transaction occur and the accuracy of the existing transaction, and then determine all of those transactions have been recorded. Okay, second is existence and accuracy, which recorded capital share transaction occur and are accurately recorded. Meaning is involving issuance of capital share such as issuance of new capital share of cash, the merger with another company through an exchange of share, donated share, and the purchase of treasury share. Okay. Next is the existence can ordinarily be tested by examining the minutes of the board director meeting for proper authorization. Auditor can also readily verify accurate recording of capital share transaction for cash by confirming the amount with the transfer agent and tracing the number of the recorded capital stock transaction received. Is accuracy, where capital share is accurately recorded. Auditor verify the ending balance in the capital share account first by determining the number of outstanding at the balance sheet dates. Then the ending balance in the capital in excess of par account is residual amount. It is audited by verifying the amount of recorded transaction during the year, and adding or subtracting them from the beginning balance in the account. Lastly is presentation and disclosure, where capital share is properly presented and disclosed. The auditor should determine that each class of share has a proper description, including the number of share issue and outstanding and any special right of individual class. Next is auditor should verify the proper presentation and disclosure of the stock option, stock warrants, and convertible security by examining legal document or other evidence of the provision of agreement. This is about audit of dividend. Accuracy or existence, where is recorded dividend occur. Completeness is where existing dividend are recorded, and accuracy is dividend are accurately recorded. This slide also tell us about audit of dividend, but more to the dividend payable, whereby occurrence or existence is dividend are paid to the shareholder that exists. Completeness is dividend payable are occur, and accuracy is dividend payable are accurately recorded. This slide I will explain about audit of retained earnings. Transactions that involve retained earnings are net earnings for the year and dividend declared. There may be correction to prior period earning, prior period adjustment, and appropriation of retained earnings. Okay, the first step is auditor first analyze retained earning for the entire year, which include description of every transaction affecting the account. So then auditor will trace the entry in retained earning to the net earning figure in income statement to accomplish the audit of the credit to the retained earning. After the auditor certifies that the recorded transactions are correctly classified as retained earning, next the auditor decide whether they are accurately recorded. After that, determine accuracy depends on the nature of transaction. And then auditor should evaluate whether any transaction should have been included but were not. For example, if the client declares stock dividend, the market value of the security should be capitalized by debit to retained earning and credit to capital share.
In conclusion, the audit of the capital acquisition and repayment cycle involve assessing the unique characteristic of the cycle, examining relevant account and performing specific audit tests to ensure accuracy and compliance with legal obligation. Proper audit procedure help verify the financial integrity of the capital transaction and related account.